Okay. Yeah, I started recording too. So, okay, so this is one share of Apple. Now, what this means is that out of, let's say there's 1,000 or 100 shares total in Apple. That means you have 1 out of 100,
Hmm.
meaning you have 1% of Apple. That's how much you own. Now, oh fuck. Um,
Hmm.
Now, the way this share is priced comes from a couple different things. I fucked it up. Okay. So, the current price, it closed today. Stock market closes 4 o'clock Eastern Standard Time. It closed at
Yeah, I know.
$122.06. Um, sorry. It closed today at 120.22. The high today was one. Wait, no. Oh, it started off the previous day at 122.06. So that's what that is. Um, Now there's several things that go into a stock. So if this is the company, making it look like a factory, um, this
Mm.
represents you, and then this is the share. This is how it happens. So
That's the share. Yeah.
what happens is that fuck, it's so um when you're going to trade with someone else, or you trade with the company. So what the company does is, let's say I own this company 100%. However, this
Hold
company
on 1 second, Max. I gotta go do something.
this company doesn't have much money. Okay, we're waiting on them. In the meantime, I will show you why this is how you make money. All you do is you just are you watching, Theo? Theo,
Hmm?
you're not watching.
I am now. Money.
This is how you make money.
Graphs.
So it just gets bigger and bigger. But
Graphs is how you make money?
kind of, not really. So I'm gonna show you what I'm talking about, and what I think is more powerful is something called fundamental analysis, and that's looking at stuff like financials. This is super important. Um, Looking at what the fuck, statistics. This is super important. Profit margin. That's a huge thing. That's such a important thing. Um, that if you're just trying to fuck along with
Your mother.
Theo, you're not watching the stream.
No, I am.
You're not.
Yes, I am. You're on Yahoo Finance. There's a Paramount Plus ad and a Yahoo Finance ad under that.
Interesting. Um. So, this is super fucking important. Because if you look at, so for example, we'll talk about the price to earnings. Price to earnings is you're taking the price, so let's say it's $30, That's per share. Dividing it by your earnings per share. Wait, why aren't you mod anymore?
Yes, I am.
It doesn't have your mod name.
So it's on a mod.
Okay. Good. So. What's up, Azure? So, what we're gonna be doing Jesus fuck. You are paying the company. So let's say I own Apple. Yes, I am Steve Jobs. Haha, look at me,
Damn.
Steve Jobs. Now, we don't have much money. And we don't have much money because I only put in like $10. And we started making phones. We could only make 3 phones though. We sold them for a bit, but we want to make more money and quickly. So what we do is we say, you know what? I really want more money. So I will sell you part of the company in order to grow the company quicker. So you pay, let's say I'm like, buy it for $30. And you agree to buy it for $30. Actually, you're not watching anymore.
Actually, you got it. You don't have to like be like there the whole time. Like, just keep it open, okay? The more viewers there are,
the better.
The higher up it is.
Yeah. Alright. So, when you have once you've paid that money, you get the 1 share. And again, remember, that value is only intrinsic to what someone else will pay you for it. And so what that means is it's when someone's first selling shares, you can't go and just sell it to anyone for that instant price automatically. However, if you're putting it on the open market, then what you're doing is you're saying, you know what? Anyone can buy these shares. And so when anyone can buy the shares, a bunch of people are like, hey, I might like to buy these shares. So they buy them. So let's say people now have 30% the company, and I, as Steve Jobs, own 70%. Makes sense? So, we now have, because people are trading them and buying and selling, Theo, fuck it, you're muted. Buying and selling back and forth, the market decides a price. And so, when you have, so let's look at the volume for today. Yeah. If we look at volume, 164 million. 0.5. That is how many shares individually were traded. That means over 160 million times you had someone buying and selling. That's insane. It's more, and the average is 107 million. So you would just have boatloads of shares being traded, and because they're traded so quickly, you find that the true value comes to reveal itself, or the value that the market deems to be true. Okay, so now let's look at dividends. So let's say I, as the company, make $10,000, okay? However, I don't I only need 9,900 of that for growth. I can give away from that $100 and give it back to the people who own the company. So that means if I own 70% or 70 shares, if there's 100, I get $70 from that as Steve Jobs, the one, the only. Now you, or however many people trading, the money comes from the other $30. From the shares, it's allocated by share. And you get $30. $30.
Yep.
And so that is called a dividend. So if you look at for a dividend and yield, this means on February 5th, that was previous. So on February 5th this year, thanks for following. It means that they will be giving 82 cents or for the future date. So that was previously. But for the next one, they're going to be giving 82 cents. And what that means is for the share price, which is $120.13, that means that you're getting 0.67% of that share price. So one of the things you can do is look for a stock that's giving back a really high dividend. Actually, so we'll just look at right? Yeah, it's T. So if you look at this and we go to the dividend yield, you'll see dividend yield is 7.19%. That means that every time they're going to pay you, that payment is going to be 7.19% of the share price. So you're getting quite a bit. And what that means is that you don't have to rely on the prices to change. So if you look at AT&T stock, over a long time, you're actually not going to see much price change. You're actually going to see a decrease because it's an older stock. And what that means is that fewer people are, or there's less areas in the company. If you're looking at where you can spend money in a company, as a company gets bigger and owns more of the market, the research and development, first of all, goes down, as well as the costs for growth. So what that means, they go down. Jesus fuck, it's so hard. That's because when you have a company that has a really large infrastructure or market share. So what I mean by that is if you have a company that, like AT&T. So if you think about AT&T, they have a ton of cell towers set up. They don't need to be putting money into making new cell towers. And that's really vital to their success. So what that means is that, or to the success of a dividend stock. And what that means is that that money can be put into the dividend. So some people kind of hunt for dividend stocks because they can get you a ton of just cash. You get cash right in your hands instead of relying on the market. other thing that you can be looking at for stock is, first of all, we're talking, this is for market cap. What this means is that if you look at the total, if you add up all the different stock prices, it's saying, well, how much is this company worth? And so for Apple, it's 2.05 trillion, which is the second or third largest, which is pretty impressive. One of the most important stats in my mind is the profit margin. So what this is saying is you're earning some amount of money. You know what I mean? So you're earning $100 for some company, and then it's asking what amount of that money do you actually get as profit. And profit is money that you have without loss. Because if you make $100, but you have to spend $100 to get that, well, you actually haven't gained anything. All you've done is just made transactions occur. And so for a lot of people, that's not what they want, which is where that where the profit margin comes in. And so 20% is super high. So let's look. What is a good bet margin for retail? So one of the really important things to think about is that profit margins heavily vary by business. So if you look at retail is going to be as high as fuck. But if you look at, let's see, like wholesale, it's going to be much. Oh, okay. Well, fuck.
Do you have another guy in your chat?
Yeah. What's up, bro? If you're in chat, drop a hello. For a food truck, Jesus, 7 to 8%. So yeah, restaurants make they have a super low profit margin. So if you look, there's companies that deal with restaurants, the stocks. Those profit margins are going to be a lot lower. What that means is if they stop making the same amount of money, yeah, what's up, Lair Bill? It means that they're not going to be able to sustain themselves. So it's much easier for them to go into losing money. However, think about it like this. You also have to pay attention to, because the food business is something that, like, I would hope that everyone eats. I'm pretty sure everyone needs to eat. Not everyone needs a new iPhone. So when it comes to what people are going to stop spending money on if there's a problem in the market, generally, tech companies suffer more. So you're going to see a higher drop in the profit margin. Another really important thing to look at is your return on equity. So what that means is the amount of money that is in the company, like the amount of company owned. How much is the company making on that money? And you can look at it return on assets too. Like that's how much what they physically have. It's saying how efficient are they at taking money from the resources that they have available. And so, as you might imagine, that's pretty useful when it comes to seeing if a company is really going to be secure and going to be a good long-term solution, or whether it's going to be something that might succeed shorter term or even fail both long-term and short-term. One of the things that is super that you'll see when it comes to the GameStop fiasco. Oh shit. If you look, fuck, dude, look at all this. If you look at the shorts, that's short percent of. Whoa, wait, I'm not sure. Okay, so your short percentage of shares outstanding. That means like, how much shortage do you still have? Because the thing is, this used to be shorted more than 100%. This means, okay, so actually it is. What this means is that you have leveraged shares. So an institution can actually have more shares than actually exist, because they're able to either borrow money, or to use options, or to use something that lets them be tied to the stock price without having to actually own shares. And so you can have many different, and let's look at this. So if we go back to our other metrics, profitability, look at that. They're losing money with every year of selling shit. They're actually just losing money. And so that's sort of company. Fundamentally, so this is looking at fundamentals. This company's not good. If we look at the return on equity, that's super horrid. Return on assets, really bad. If we go back to our summary, we have a lower volume, which means it's going to be a bit more volatile. No dividend, so no one's going to be buying it for stability. However, no dividend does mean the company can grow quicker. That's just, it's a trade-off there. But if we look at like, so this is cash per share. So it's saying for every share, which costs 130, I can't believe it costs more than an Apple share, you have $6.39 of cash that the company has. However, if you look at this, I think that's for every you have $347 of debt per every $1 of cash, I think is, and that can be exaggerated by the fact that some of that cash, you could have cash and that cash could be borrowed. So, current ratio, I think that's looking at cash, I'm not sure. But looking at this sort of stuff kind of gives you an idea of the general direction that a company's going towards. So yeah, that's pretty important. Let's see. Does anyone have any questions about this sort of thing and want to direct what we're trying to do? Yeah, you can pop it in chat if you have any suggestions. But yeah, I think one of the right now with the lowered price, if it as long as they, I mean, I would buy below as soon as it gets below 26, I would set something just for 26, but a limit purchase for 26, and I would buy for that. I'm not a financial advisor, by the way, but if you look at this, is also something that should be going to $20. However, it recently had, this is not real money, this is paper trading. It recently had a huge tank, and so this is prime for purchase. This is a company that I am super positive in terms of the mid to long term. In fact, if we look at this is saying in terms of the, so I would not look at these. These are technicals. Technicals tend not to be effective. I can show you some studies on that. Oh, my bad. But so what this is, these sorts of things are built on technicals. But what I was going to say is that if you look at the spread here for tomorrow, this means that at the beginning of the day, as of right now, the lowest price that people are willing to sell at is $16. That means it's super widespread, and it's way closer to the 16 mark. That means it should start, or it should begin the day, hopefully around 15. Of course we can't know for sure. But that's something that, even if it's at 15, it should be going to 20. You're getting losses in revenue in 2020. If we look at it quarterly, though, you can see that was all in the first quarter 2020. That's super important to look at. Okay? Because if you just look at the annual, like, oh, fuck, they just keep losing. No, they got hit by COVID. Okay? And then they're recovering. Housing stock should be recovering decently. Another good one, because I care a lot about the housing stocks. That's been down. That's pretty good. Is Black Knight. Another strong one. DHI. If you're looking at the technicals and you care about that, then I mean you can see this is pretty positive for technicals. Guys? Sorry, I think my stream dropped for a second. I'm back. Okay. Yeah, if you care about the technicals, DHI is pretty fucking good. And it's just good overall. The way their business model, if you like, this is insane. The fact that they're able, first of all, great profit margin. Okay, I'm gonna rave about this for a bit. And it's down right now. 12% for a fucking home builder. Holy shit, that's amazing. Okay, the other part. Look at that. They're growing. I mean, the best quarter was quarter 3, which was like in a fucking fuck, you understand what I mean. In the middle of the coronavirus. Yeah, just great earnings. Okay. Just about 9:30. I think we should wrap it. I hope everyone learned some good shit. Yeah, I'm gonna help.